Have you ever wondered why so many beginners lose money in the stock market, even when they're trying their best to do everything right? The stock market isn't just about picking winning stocks, it's about avoiding the common mistakes that quietly drain your money over time. In this video, I'm going to walk you through the biggest stock market mistakes beginners make, why they happen, and how you can avoid them from the very start. Understanding these pitfalls can save you years of frustration and help you build confidence as an investor. Before we jump in, if you want clear, beginner-friendly investing advice that actually makes sense, hit the like button, subscribe, and turn on the bell so you don't miss future videos. Investing money you can't afford to lose. Here's the thing about the stock market. It goes up and down. Sometimes it goes down a lot. And if you're investing money that you need for rent next month, or your car payment, or an emergency, you're setting yourself up for disaster. The stock market should only hold money that you won't need for at least 5 years, preferably longer. Before you invest a single dollar, you need an emergency fund with 3 to 6 months of expenses saved up. You need your high-interest debt paid off. You need your basic financial foundation solid. When the market drops 20 or 30%, and it will, you need to be able to ride it out without panicking and selling at a loss, because you suddenly need that money. Investing money you can't afford to lose turns investing into gambling, and that's not a game you want to play. Chasing hot stocks and trends. Every beginner does this. You hear about a stock that doubled in a week. Your cousin made money on some cryptocurrency. Everyone's talking about the next big thing. So you jump in without doing any research, hoping to catch the wave. But here's what usually happens. By the time you hear about it, by the time it's all over social media, and everyone's talking about it, the smart money has already gotten in and is getting ready to get out. You end up buying at the peak and watching your investment drop. This is called FOMO, fear of missing out, and it's one of the most expensive emotions in investing. The stocks that everyone's excited about today are often the ones that crash tomorrow. Real wealth in the stock market isn't built by chasing trends. It's built by boring, consistent investing in solid companies over long periods of time. Not diversifying your portfolio. Putting all your money into 1 or 2 stocks is like putting all your eggs in one basket and then juggling that basket on a tightrope. It's unnecessarily risky. I've seen beginners put their entire portfolio into whatever stock their friend recommended or whatever company they work for. Then that one company has a bad quarter, gets hit with a lawsuit, or faces industry problems, and suddenly their entire investment is down 40 or 50%. Diversification means spreading your money across different companies, different industries, and different types of investments. When one goes down, others might go up or stay stable. This doesn't guarantee profits, but it does protect you from catastrophic losses. For most beginners, low-cost index funds that hold hundreds or thousands of companies are a much smarter choice than trying to pick individual stocks. You get instant diversification without having to be an expert. Trying to time the market. Beginners love to try timing the market. They wait for the perfect moment to buy when prices are lowest and sell when prices are highest. Sounds smart, right? Except even professional investors with teams of analysts and sophisticated computer models can't consistently time the market. What usually happens is you wait for a dip, but the market keeps going up, so you miss gains. Or you buy the dip, but it keeps dipping, and you panic and sell at a loss. Or you sell because you think the market's about to crash, but it keeps climbing, and you miss out on growth. Time in the market beats timing the market. Historical data shows that people who stay invested through ups and downs do far better than people who jump in and out trying to catch perfect moments. The best time to invest was yesterday. The second best time is today. Panicking and selling during downturns. The market drops 10% and beginners freak out. They see red numbers everywhere, and their first instinct is to sell everything before it gets worse. This is the absolute worst thing you can do. When you sell during a downturn, you lock in your losses. You turn a temporary paper loss into a permanent real loss. Market downturns are completely normal. They happen all the time. The market has always recovered from every single crash in history and gone on to make new highs. If you sell during the panic, you miss the recovery. You buy high when everyone's optimistic and sell low when everyone's scared. That's the exact opposite of what you should do. Successful investors see downturns as sales, opportunities to buy good companies at discount prices. They don't panic. They stay calm, stick to their plan, and often buy more while prices are low. Ignoring fees and expenses. Fees seem small, but they're absolutely deadly to your returns over time. A fund that charges 2% per year instead of 0.2% might not sound like a big difference, but over 30 years, that extra fee can cost you hundreds of thousands of dollars in lost returns. Beginners often don't pay attention to expense ratios, trading commissions, account fees, and hidden costs. They add up fast. Every dollar you pay in fees is a dollar that's not growing for you through compound interest. This is why low-cost index funds are so popular with smart investors. They give you broad market exposure with expense ratios under 0.1%, sometimes even lower. Before you invest in anything, look at the fees. If someone's charging you 1 or 2% per year to manage your money, they better be providing incredible value, and most of the time they're not. Keep your costs low and keep more of your returns. Making emotional decisions. Fear and greed are the two emotions that destroy beginner investors. When the market's going up, greed makes you invest more than you should, take bigger risks, and ignore warning signs. When the market's going down, fear makes you sell everything and hide. Both of these emotional reactions cost you money. Successful investing isn't exciting. It's boring. It's following a plan regardless of how you feel. It's not checking your portfolio 10 times a day and freaking out over every fluctuation. It's making a decision based on research and strategy, then sticking with it through good times and bad. Before you invest, create a plan. Not doing your own research. Many beginners invest based on tips or social media hype without understanding what they're buying. That's risky. Just because a stock is popular or someone else made money doesn't mean you will. Always know what the company does, how it earns, and what risks are involved. If you can't explain why you're investing in simple terms, don't invest. Do your homework. Your money deserves it. At the end of the day, successful investing isn't about being perfect. It's about learning from mistakes before they cost you too much. Avoiding just a few of these common errors can make a massive difference in your long-term results. I'd love to know, what's the biggest investing mistake you've seen or experienced so far? Drop your thoughts in the comments. Your experience could help someone else avoid the same trap. If this video helped you invest smarter and with more confidence, don't forget to like, subscribe, and share it with someone who's just getting started in the stock market. Thanks for watching, and I'll see you in the next one.